You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. The Options Insider Radio Network is sponsored by Fidelity Investments. Fidelity's Option Trade Builder tool can help you confidently build an options trade in 3 simple steps. Just choose a strategy, select a contract, and then review the benefits and risks of the trade. Learn more about Option Trade Builder at fidelity.com/options. Options trading entails significant risk and is not appropriate for all investors. Certain complex option strategies carry additional risk. Before trading options, contact Fidelity Investments by calling 800-544-5115 to receive a copy of the characteristics and risks of standardized options. Fidelity Brokerage Services, LLC, member NYSE SIPC. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. Be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered, with market data reports ranging from open interest to the term structure of volatility. QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. Investors in the U.S. and around the world are using FTSE Russell indexes to benchmark their investment performance and create investment funds, ETFs, structured products, and index-based derivatives. Many Options Insider Radio Network listeners will be familiar with the Russell 2000 Index. Russell 2000 futures and options are currently trading on the Chicago Board Options Exchange and CME Group. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody, that music means it's Thursday. It's 1:30 p.m. Central. It is time to talk some futures options. Yes, it is time for TWIFO. My name is Mark Longo from the old OptionsInsider.com, as well as, of course, from the ever-exciting, at least we hope so, Options Insider Radio Network. Got a lot of fun stuff to get to on the show this week. And joining me to help me do just that, old friend of the program, Mr. Blue Putnam, the chief economist over there at CME Group. Blue, welcome back to TWIFO, sir. It has been too long.
Thank you, Mark. Good to be here.
Yeah, you enjoying this polar vortex we got going on over? I believe you were scheduled to be in studio today, but I think saner and indeed warmer heads prevailed, sir.
That is correct.
So you're joining us from parts unknown, perhaps across the street at CME HQ, perhaps in your warm home. I don't know. But we'll have fun nonetheless. Now, Blue, I know you put together some interesting stuff. You guys, of course, can check out all of Blue and Eric and the rest of the team's research over there at CME Group. In fact, they feature a lot of it. If you go to the homepage, you'll see their research front and center quite often. And if you do that right now, you'll see Blue's most recent research about the market challenges posed across a wide variety of complexes for 2019. He hits them all: FX rates, you name it, equities, crude, or energy. And so, Blue, I thought we would dive into that here on the show today, but break it down by product category. So I thought we'd kick it off. Let's kick it off in a product category that's moving quite a bit. Then I'd be curious to get your thoughts on some of your research and the most recent problems and challenges that lie ahead for 2019. And we'll see how many we can fit into the show. That sound like a plan, sir?
That sounds like a plan.
All right, we'll kick things off then in energy with crude lighting it up again this week. It's been an interesting week for crude bulls. We saw yesterday crude going up about nearly 2%, hitting a 2-month high, 54.25. Today, breaking through WTI, breaking through the 55 level. Of course, coming off that a little bit now, but still, if it had held that, it was around a gain of 21% for the month of January. That's the best month WTI has had since 2015. 55 was viewed by many as a very key resistance level out there. What's been driving all this? Well, a number of things. That big, it's up 6% since Tuesday. That's when the sanctions went into effect against Venezuela. That, of course, took some crude off the table. Prices spiking as a result. We also saw a combo of U.S. crude inventories rising a bit less than expected. Stockpiles of gas and all their energy products also shrinking. So that, of course, extending the data or extending the rally, as well as data coming out of Riyadh that showed a drop of 1.1 million barrels in Saudi exports to the U.S. So that shows that at least Saudi Arabia staying and sticking to their promise out there. So it's been interesting stuff, kind of a 1-2-3 combo punch that combined to uppercut crude north of that 55 level. As we come into showtime now, right around the 54 level or so, up net a half on the week, but in terms of on that future, but a lot of things going up out there this week in crude land. So let's start there, Blue. You've had a lot of time, I think, to analyze. I'm sure a lot of people are very interested in your analysis of all things energy. What are your thoughts on the challenges for the energy complex in 2019?
Well, there are quite a few. Now that we're back over $50 and in the $54, $55 range on WTI, U.S. crude oil. So that's a good price for U.S. shale producers. They can definitely make money on that. So they're going to continue to drill wells into 2019, and the supply will continue to go up from the U.S. Now, the Venezuelan issue is tricky because that's it's a heavier crude, but it's one that a lot of U.S. refiners in the Gulf of Mexico are set up to use. So if you cut that off, they can't automatically, not all of them can use the lighter WTI, but so Canada plans on shipping some of its heavier oil our way down to the Gulf. So you have this different grades of oil, what can refiners use, and then you have the shale producers doing more. That's on the U.S. side. And, of course, on the outside of the U.S., everybody's looking at Saudi Arabia, as you mentioned, to see whether they really do cut production. And to the extent that they do, that can push Brent oil up a little bit. So a lot of things going on there in the oil sector right now. But I think we're in a sweet spot between this $50 and $60 barrel on WTI. I don't really. We'd have to have another shoe to drop to push us out of that range.
So you think we're hovering here for the near term? It was a good sign, at least for a little bit, that they're threatening that 55 level, right? So that's something for the crude bulls to sink their teeth into out there. Let's see what's been going on out here from an options perspective on WTI. Again, cmegroup.com/TWIFO, the place to go to follow along on these reports, or log in over there at Bantix or QuickStrike.net to check it out for yourself. And looking here with all this rally ho mode in WTI, not surprisingly, crude vol taking a bit of a break off multiple handles kind of across the board out there in the front portion of the term structure on the futures. Again, that's not surprising. Some of these interesting concerns of late are coming off, and also a lot of the premium was to the puts. So if we're rallying into the calls, you're going to see the vol come off a bit as well. So again, kind of a bit of a combo punch to hit some of the vol out there in crude land. In terms of action this week, OI up a relatively paltry 2.1%. So overall OI change, not a big week for WTI option. Let's see what was trading it up out here, though. Almost half of the action, 47% coming in this March contract. Let's see what was lighting it up. Double calls, 55 calls were kind of leading the dance. In fact, 55 calls were the big strike across the board here. 13,123 of those going up here this week in March. 3,700 on Monday and about 2,500 Tuesday and Wednesday, and almost 5,000 today. So the lion's share actually coming today. Slightly biased towards opening, but if you look across the term structure here, you're seeing it out in June, double calls, 3,500 leading the dance out there. We have it also in May, 1,500 of them going up there. So double strike's a popular one, even all the way out to the less popular July, only 700, but still number one trade out there in that month as well. So doubles are where the action is. If you come off that strike a little bit, though, it's kind of very near term around that at the money level. 50 puts, number two, 11,500 of those going up this week, net opening by about 2,500. And 60 calls hot on their heel, 11,500 of those as well. Net opening of about 1,200, doing about 4,400 today. So pretty action-packed day out here for WTI. Before we roll off, so we have a lot of products to hit here. We could talk crude the whole time, Blue. But before we roll off crude, really quickly, your colleague, your compatriot, Eric Norland's been on the show a number of times as well. He has some recent paper as well, some recent research. I don't know, maybe you want to leave that commenting on his research to him. I'll certainly allow that. But if you have any thoughts, he was commenting that a recent rise in implied volatility of oil is perhaps a bearish signal. Of course, we're seeing vol coming in today and crude rallying. So maybe in the near term, not so much. But I'm looking, maybe if you have any thoughts on that in the long term, is that implied vol perhaps? Is that indicating maybe a bearish trend, or are you not feeling that, Blue?
Well, you really have to dig a little deeper. But what Eric is looking at there is that in the last couple of years, or really since 2014, vol has risen when we've had oil prices. Vol has risen around expectations and events that caused oil prices to decline, which is, what we had some of last year. But now we're really in the current event is much more politically determined. That it's the Venezuela situation, it's the OPEC cutbacks, and it's how much the shale producers will tend to go. So. As you just pointed out, though, the interesting thing is there's lots of volumes on the call side of the market. And, and that tells you that there's an interesting debate going on whether oil prices are going to go higher or not. There's a buyer and a seller for both sides of the things. And that, the buyers are really suggesting that the political events are going to drive oil higher. The sellers are saying, well, wait a minute, there's a lot of U.S. shale coming down the pipeline. So we'll see how that works out.
We'll see indeed as we keep on rolling to our next complex. Let's talk a little bit of equities here, Blue. We just came off a show where we talked a lot about volatility in the equity options world. Of course, it's earnings season right now. That's a big driver of volatility. Sometimes has a net aggregate effect of tamping down on index volatility as well, which perhaps we're seeing as a result today. A lot of equities feeling the love after some strong earnings this week. Most of the major indices up fairly strong today, except for the Dow. Bit of a laggard out there in the Dow, which is kind of interesting. old economy versus new. I suppose you can make that argument there. But looking at the vol out there, of course, S&P vol, aka VIX, south of the 17 handle, 16 and change out there now. And our old friend RVX, aka the Russell 2000 volatility, right around 1950. So we're looking at a spread there of about 2.7 right now. So a little bit tighter than it has been. And that has been about 3.5 to 4 of late. Blue, I know people are hitting you up constantly about the equity side of the space and what's the challenges out there. I know you spent a lot of time researching this, so break it down for our audience, sir. What are some of the big challenges you see lurking in the future for the equity markets here in 2019?
Well, let's turn first to the volatility that you were talking about. Typically, when equities fall like they did in the fourth quarter, they fall sharply and they fall fast, and that sends volatility way up. Then after you find the bottom, and we've obviously done that earlier in January, and you start to grind higher with some pretty good days, and the vol comes down. And then in addition to that, we had the Fed meeting, and one of the things that came out of the Fed meeting yesterday was a very clear indication that the Fed thinks the economy's fine, but they understand that if they don't get that right, they're prepared to lower rates. They're prepared to use their balance sheet again. They're going to pull out all the stops to help the equity markets and the economy if, in fact, things don't turn out as rosy as the Fed is projecting. So that also helps to actually lower the volatility that you see in the equity market. But and then if we turn to what the equities are actually looking at, again, Q4 2018 was very interesting because a lot of us have been saying, wow, the Fed's been raising rates. We got this trade war going on with China. All these things hit with a lag. It doesn't you don't just turn it on and off. And the lag meant that we're going to see slower global growth in 2019. And that's kind of what got discounted in the equity markets and triggered that sell-off. But what that means now is that equity markets are pricing a pretty big wall of worry. I mean, they're worried about a lot of things. And when you're worried about things, it's actually a little easier for the market to grind higher as long as none of those worries turn out to be true. So the data will tell us that later in the year, but we're at much better places in the equity markets in terms of the risks that are being discounted and priced, and then you have the Fed having the equity markets back again. So so we're grinding higher until we get some bad news. If we are going to get bad news, we have two event risk days coming up. February 15th is when if the U.S. government is going to get shut down again, that would happen. Probably not, but you never know. And then on March 1st, that's the U.S. set deadline for the deal with China. Now that could be delayed if they're making progress, but the U.S. has promised to put many serious and penalty tariffs on China on March 2nd if there's no deal. So those are two kind of event risk days that are going to be important for equities.
Yeah, certainly days to keep an eye on there. Speaking of things to keep an eye on, let's check here. Let's keep an eye on what the activity was so far this week out here in the equities. Let's start off in the E-mini S&P 500 options. Again, you know the story about the vol already. I don't need to repeat that to you. Vol coming off. Equities coming up, at least so far, towards the latter portion of this week. Where was lighting it up? Well, the E-minis hovering right around that 2,700 level right now, and we're seeing, surprise, surprise, that front week contract with about a couple fractions of hours to go is lighting up the contract, the last of the Jan contracts out there. 2,700 calls, 26,600 of those on the tape. That's kind of where the lion's share of the action is. Again, not surprisingly, we've seen this even numbers tend to draw the imagination, draw the flow out here. 17,600 of those going up today. So today, by far, the most active day for that contract. Then we got to go out a little bit here to the 2,700s in week one. So it's a bit of a theme here. Week one of Feb also getting the love, 16,200 of those lighting it up. And actually, you know what? I missed one, but way out here all the way out here. That's the problem with E-mini. So much of it trades so far out the term structure. You have to go out to check out everything. All the way out in March, the 2,500 puts actually with 20,500 of those. So those actually would slot right in there at the number 2. So it's not all bullish all the time, listeners. Some people at least playing in the puts. Again, they could be writing those. We don't know. Have to dig in a little bit more to find out. But those actually traded pretty fairly evenly throughout the week, about 5,000 and change or close to it just about every day, and about 6,800 today. Net slightly closing. So maybe some people taking off some risk down there to the downside. But interesting stuff. Let's check out here really quickly as well before we keep rolling out of equities to see what our friends over there at the Russell have been doing this week. If it's a similar story, again, the Russell 2000 options been growing quite a bit out there at CME. Growing again this week. OI up nearly 10%. 9.7%, so another robust week. And where was the action? The Russell 2000 at 1495 coming into showtime. We're seeing the action out there in the March 1315 put, the biggest player out here this week. So a little bit of perhaps downside interest out here in the Russell, which is kind of interesting. I lied, Blue. One last thing before we roll out of equities. I'm going to make you talk for Eric again because he's got a bunch of stuff coming out recently as well that dovetails a lot with this show. He was mentioning how perhaps equity index vol and treasury options vols are perhaps diverging a little bit of late, and what that might lead and store for the equity markets going forward. Any thoughts on that, Mr. Blue?
Yes, actually, Eric was right on top of that one because, in the fourth quarter when equity vol was headed higher with the sell-off, people were realizing that this could actually be a wake-up call for the Fed. The Fed had been telling us all through 2018, we're going to keep raising rates 3 or 4 more times in 2019. We're on autopilot. Everything's fine. And then equities told the Fed and everybody else, not so fast. It's not so fine. And the bond market, took that to heart and said, I can be a little more calm here. And so you got a volatility, the divergence there that showed up. And, you've got some longer run issues that we've spent a lot of time doing research, and that's when the yield curve gets as flat as it's gotten now. And it got that way, in the middle of 2018. It's a pretty big signal of equity volatility to come, and we've already seen some of it, and it's probably not over. And then you were mentioning all the action in the puts in March. Well, that's all about the trade deadline deal. How do you manage that risk, and what positions do you take? But what you're worried about is that if there's no trade deal, then equities could decline. And, if you believe there is a trade deal, then they don't really rally. They rally a little bit, maybe a little relief rally. But it's the downside people are worried about managing that risk. So that's the action there in those March options.
I know you love yourself some Fed talk. You can probably do the rest of the show on that, Blue. But I think we have a listener question about that. So I want to save some of that for then as well. Make sure the listeners get their love here on the show as well. Let's keep on rolling. A segment that has been top of mind quite a bit, certainly since the trade war dawned, Blue. That is indeed the ags, and in particular soybeans. I've said it before on the show. I'll say it again. If you want to find one area that's really kind of ground zero for the trade war and its impact here on the U.S., look no farther than soybeans. That's pretty much where the lion's share of the weight has been felt. The issues with, of course, we saw a month last year with zero imports from China, in terms of Chinese importing U.S. soybeans, all of that going to Brazil, and some questions about whether that will come back. So a lot of interesting stuff going on out there. Coming into showtime, we're seeing the beans at 920, off about 10 handles on the week. Volatility, kind of a bit of a mixed bag. The front portion of the curve looks like spiking this week, whereas a little bit later coming off a little bit. But we always see that out there in the ags. They have, shall we say, the funky term structure when it comes to volatility. And OI up pretty strong this week, up nearly 6%. Blue, I know it's been a big area of focus for you is in terms of the impact on ags. What do you see as the big challenges for the ags complex going out here in 2019, sir?
Well, you've hit on a couple of them. Obviously, the trade war is important, particularly for soybeans. China used to buy a lot of U.S. soybeans. Then the trade war started, and they said, well, maybe we won't buy them. We'll just buy a lot more from Brazil. And more recently, as tensions have eased a little bit, China has bought a few soybeans. The issue, though, is that even if we get a trade deal, it's unlikely that China will buy as many soybeans as they once did. They'll buy more than they did in the second half of 2018. That won't be hard to do. But whether they go back to full speed buying from the U.S., that's really not likely, because the trust with China and the United States it's not going to be repaired easily. So Brazil's the big winner there. But when you get any kind of buying from China, even if it's not as much as you'd like, you can get some move upward in the price, and then you evaluate what's coming down the pike. And then we've got, we got the El Niños happening, and it's not the strongest El Niño around this time, but that suggests there'll be some pretty good weather for Brazil and Argentina to produce their soybeans, some good weather for the U.S. as well. One of the things I'm looking at is what are U.S. farmers going to plant in 2019 when the spring planting comes up, and the estimates that I'm kind of writing down on my little pad is that they're going to plant a lot more corn and a lot less soybeans than they did last year. So some interesting things definitely happening on the ag front.
That is interesting. A lot of people have been asking us that question. That's kind of one I've been mulling over myself. Did the trade war at the end of the day do irreparable harm to U.S. soybean markets and soybean exports to China in particular? It sounds like you think it did, Blue, that, regardless of what happens going forward, China will be looking to Brazil more or perhaps just curtailing their U.S. imports as a result.
Yes, in the futures markets, we often talk about, you'll get a lot of technical momentum in one direction, and then something happens and you'll get a 50% retracement or something like that. And this may happen in the trade war where we only get maybe half of what China used to buy from the U.S. Coming back to the U.S. So I really believe that we've had permanent changes in global supply chains. And in this case, it's China will buy from the U.S., but not as much as they used to. They'll diversify where they get their supplies because they're just not going to feel as comfortable buying only from one source. So we've had some permanent changes. That doesn't mean we won't get a lot of it back, but I don't think we'll get all of it back.
So it happens. The unintended consequences sometimes of trade wars. If you cause more trade, but you maybe do some damage in the result, maybe the net impact. Certainly be interesting to watch. Again, the beans off this week. Let's see where the action was from an options perspective out here this week. It's been out there in the March contract, nearly half of the paper going up out there. The big trade, not surprisingly, the 900 level puts, kind of that even money put. Maybe some concern. We're going to retrace some lows out there. 5,300 of those leading the tape out here this week. Vol, again, I mentioned before, kind of a mixed bag from a vol perspective. But we also saw right behind the 900s, the 880s, 5,100 of those, trading kind of in lockstep almost every day this week with the 900, maybe some verticals going up there. And then right behind it, the 890 puts with about 4,900. So pretty much a put strip, 1, 2, and 3 in the front, or I should say the March contract is what's leading the dance out here in soybeans. So all the concern, clearly all the action, a lot of it still to the put side. Skew is reflecting that. We're still seeing the puts with actually a little bit cheap. They're about 1.3% cheap to the at the money, a little bit cheaper than they were a week ago. They're about 0.5% cheap to the at the money. Calls staying pretty much the same. They're about 4.2% rich. In terms of vol to the at the money, they were about 4.1% last week, so not a lot of change there. So there is still a bid to the calls, some optimism perhaps, but the paper flow, at least this week, coming on the put side of the fence. Let's keep on rolling. Another category I know, Blue, that's near and dear to your hearts. And again, we have listener questions about all these categories as well. So don't worry, listeners, if you wrote in, we'll get to your questions with Blue here in a little bit as well. But Blue, metals, kind of an interesting area to watch of late. There's been a couple of refrains for our audience over the course of the past year. And one of them has been, what's happening with gold volatility? Why can't it catch a bid? I often joke when Eric, whenever he's on, the first time he was on years ago, I still refer to as one of the best timed research papers we've ever had on this network, because he put out a paper I believe was called Gold Volatility or Gold Volatility Storm on the Horizon, or something to that effect. And by the time he posted it, he came out like 2 days later, we saw gold vol exploding. And so he was very well timed in that regard. So he's been wearing that badge of honor ever since. But gold vol has been an interesting story. Gold itself has been an interesting story. Coming into showtime here, we're up 20 handles net on the week. Again, you can find that for yourself, cmegroup.com/TWIFO, or head on over to quickstrike.net, log in to the big boy version of the tools to see all this stuff and a lot more. So up 20 handles, 13.25 vol. again, in the front portion of that curve, a bit of a mixed bag coming in a little bit, whereas latter portions of the curve getting bid up. Obviously, blue gold is an important product out there for your research. What are some of the challenges you see for gold and indeed for the metals in 2019?
Well, what we learned about the gold market in 2018 was it didn't care about the trade war, but it really did care about U.S. interest rates. Gold doesn't bear any interest, and when interest rates are rising, it's not good for gold. Well, the Fed's going on hold, and we got a lot of people started thinking that would happen during the fourth quarter equity sell-off, and then when it did, it's been confirmed, and that takes gold all the way, from where it was sitting 1,200, I guess, a while back in 2018 to 1,325, and definitely, if the Fed stays on hold, the gold bugs are going to like this, where it could go. It's not all positive for gold. I mean, China and India both buy a lot of gold jewelry, and China is decelerating, and they may not buy quite as much. But and producers of gold are still producing a lot. They make good money here, so this is a good price for them. So you do get a little more supply of gold and maybe a little less buying from China, but I think the interest rate outlook is what's going to dominate the gold side. Now copper's totally different. Copper's an industrial metal. You don't build a country without using lots of copper, and if you're not building as fast, like they're not, China, again, as we said, is decelerating, that takes a little of the edge off copper demand. So, the trade war is the issue for the industrial metals, particularly copper, and U.S. rates are the challenge for gold. And as I said, the Fed on hold, gold can rally as it has.
Let's see what's going on out here in the COMEX gold options over here at CME. Like we mentioned, the vol, a bit of a mixed bag. The action pretty strong, though. OI up nearly 6% on the week for the options. The lion's share of that action, a little more than a third, coming in that March contracts, a little more evenly split than the beans, some of the other ones which had nearly half their volume in 1 month. And in that month, what was dominating? I said we're right around 13 and a quarter right now. It was the 13 half calls, so blue, maybe some gold bugs still out there in gold right now. 5,600 of those going up this week. Pretty evenly split today, though, getting the lion's share, about 2,400. The rest kind of split throughout the week. Net slightly opening, but again, we don't have today's number, so we don't know how that affects the OI. And then number two, 1,340 calls, a little bit closer calls, also in March, 4,600 of those. Followed hot on the heels by the 1,300 puts, about 4,600 of those as well. Again, both of those kind of fairly evenly split throughout the week, both slightly biased, about 1,000 and change net opening. So a lot of back and forth on those strikes as well. Not surprising given the fact that we kind of been vacillating around out here in gold for a little bit. Let's look at the skew here really quickly, because gold skew is one of the more fun ones to look at because it actually changes, it evolves. So that's always fun to see. Let's see what's going on out here this week. Let's look to March, because that's where the lion's share of the action was this week. And seeing the calls kind of unched about a little bit more bid than they were last week. They were 7.6% rich to the at the money, now nearly 8%. So slightly more bid, but still clearly the bid is to the calls. The puts are cheap, about 4.5% cheap to the at the money. They were 2.4%. So puts getting cheaper, calls getting more expensive. Not surprised, maybe a little bit of a near-term pop in gold. We're seeing that result. The question is, of course, can that bid maintain? Are people gonna keep that love out there for the calls? So at least in the near term, bids to the calls, which is kind of interesting. Again, the gold skew, it vacillates around. It's a fascinating one to watch. If you like looking at the impact of skew going forward, then gold is a great place to go. We have a bunch. You know what, Blue, as the guest, I will leave it up to you. We have a bunch of listener questions. We also have a couple more complexes I know you hit on in your research. So I'll leave it up to you. You want to answer some questions, which may hit on some of these complexes? You want to do maybe one more complex first?
Let's go to the questions.
All right, let's get the listeners on board. Listeners, Blue has spoken. He wants to answer your questions. Let's keep on going with a little bit of your futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/The Options Insider, stocktwits.com/Options Insider, or via questions@theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app. Available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's Mixlr.com.
All right, everybody, welcome to the Futures Options Feedback. You guys get to take the reins, dictate where we go from here on. Blue, I know you're chomping at the bit, talk some more rates and some more Feds. So Desync 81's got you covered. You kind of touched on this a little bit earlier, but let's give a definitive statement for our listeners here. Desync wants to know, are you buying that the Fed is indeed done for 2019 and perhaps beyond? Judging by your earlier comments, I'm going to wager that you say yes, Blue, but I won't put words in your mouth. What do you have to say here for Desync 81? Do you believe that the Fed is truly done for this year and perhaps beyond?
Actually, I started writing research back in August suggesting that the Fed was going to go on hold for all of 2019. And then that was really based on the view of this lagged impact. Rates go up, and then you don't find out till a year, 18 months later what's really happening, but it's usually slowing growth. In the trade war, we actually got people trying to anticipate the trade war. China exported more stuff to the U.S. in the summer, and then it only really tailed off in November and December. So, all of these trade war things are coming home to roost in 2019. So that's been my view for a long time. The fourth quarter equities kind of ratified that view in the minds of the equity guys. And then the Fed confirmed, that they're at least data dependent, and they're going to be patient, is what they said. Now, what does that mean? Well, if you're data dependent, you're not going to get your fourth quarter GMP data on time because of the shutdown. It's going to be delayed. When it does come out, you're going to say, well, wait a minute, I don't really care what the fourth quarter did. I'm interested in what the shutdown did to the first quarter. And that data is not going to show up till April. And so, the Fed is just going to sit around for a long time waiting for some clarity on the data. And I think what they're going to see is the economy continues to grow, but not as fast as it did in 2019. And I don't see any inflation pressure. It's all around this 2% area, which is the Fed's target. So, I'm in the camp that the Fed stays on hold for pretty much the whole 2019.
Interesting stuff. A lot of people were, of course, wagering on that towards the end of 2019 when we saw the impact of the velocity of their rate hikes. But it sounds like you were early on that tip, Blue, getting out there, I should say, back in August, which is interesting. Let's see. Let's go to this one. Let's go to C. Sanders. People have been asking us about this for a while. We were just talking metals, Blue. People have been asking us for a while to talk palladium. It's kind of been this surprise story, this surprise, I suppose you can call it, resurgence of palladium. C. Sanders writing in saying, what do options traders think about this development? He sends a link to an article that was titled Palladium Worth More Than Gold for the first time in over a decade. This came in, I think, about a week or so ago. So that has since changed since this came in. In fact, just in the last week or so, last few sessions, with palladium selling off now. It's at about 15 handles at 1307 or so, or 1305 or so out there this week. So 1305 gold at 13.25. So they have diverged again, but still palladium within spitting distance of gold for the first time in a while, which is kind of interesting. One of the reasons C. Sanders and everybody else who wrote in asking about what do the options traders think about palladium, the reason we haven't talked about it is that it doesn't do a lot of options volume out there. It's like, there's looks like about 65 contracts going up this week or 70. So not a huge amount. Palladium is not a big option story to tell. It's more in the futures. But that said, Blue, we were just talking about the fundamental stories for copper and for gold. Does that story hold true for palladium as well? What is behind this recent rally? And maybe do you have any outlook for palladium going forward?
Well, it's just an accident that palladium and gold are, both sitting around the 1300 levels. There's nothing special there. It's a nice hook for a story, but palladium is much more in the. Some people classify it as a precious metal, but it's an industrial metal. It's in catalytic converters and automobiles and other things. And so we've had some developments on the supply side that's given it a little push, and so palladium is going to trade on the industrial metal side of things. Unfortunately for palladium, the automobile industry is not as strong as it used to be. So I think that may be why it may be losing a little bit of its momentum, but we're going to have to watch that.
Yeah, certainly people have been hitting us up a lot about Palladium of late. A lot of it obviously due to the move. Certainly not due to the options paper. It's just for whatever reason, that one of those ones that doesn't trade a lot of options. But interesting underlying movements nonetheless. And you're right, Blue, the fundamental story driving it. Kind of a bit of a mixed bag, which makes this recent resurgence and then near-term sell-off certainly interesting. We'll keep an eye on it there when we were at the C. Sanders, and if something happens, of course, we'll talk about it. But this is an option show primarily. We just don't have a chance to sink our teeth into what's going on out there too often. Let's see here. Here's a good one, actually, Blue. Yeah, good one for you to sink your teeth into as an economist. I think this will resonate with you. This comes from Uncertain with a 1. Fancy spelling out there. He or she asking, I've always heard the saying that when things get crazy, correlation goes to 1. I know that holds for individual stocks and indices, but does it also apply to commodities and other assets? Blue, this has been a fascinating thing. We talk about this a lot on the network. The traditional, particularly on the equity side of the fence, the traditional portfolio diversification, the old school Markowitz portfolio theories that you needed, 60-40, equities, and then maybe some fixed income, maybe 60-30-10 with that 10 going to gold if you were really crazy. And then you kind of did all of your due diligence in terms of portfolio diversification. Of course, as our listener points out, when things get crazy, we do see some of that correlation tend to spike, which really reduces the impact of the hedging value of those other diversifications. I'm curious in general, Blue, first off, what do you think about that statement in general about the correlation going to 1? And then B, as our economist and keeper of the research data for these broad spectrum of products, what do you think in terms of their question of applying it to beyond equities to all these other asset classes?
Okay, well, first, the statement correlation is going to 1 really applies most accurately in equities, as the listener pointed out, and it applies when equities are declining. Because equities decline, when they do go down, they tend to go down pretty sharply, pretty quickly, and people just sell whatever they own. They're not they're not really thinking about, do I want to sell A or B? Let's just sell a little bit of A and B. So you do get the correlations of the stocks going toward 1. You don't see that nearly as much in other commodity markets, like take agriculture. So the end of May, last June and July, that's when 2018, when the trade war really got going. That's when China said, hey, U.S. put tariffs on us, we're going to stop buying your soybeans. Soybeans dropped 20% right away. Corn dropped a little bit, and wheat didn't go down at all. Now, what was wheat? What was going on differently there was that soybeans was the only major U.S. crop impacted by the trade war. And wheat, for instance, was actually impacted by some not-so-good weather, drought conditions, and so forth in the Ukraine and Russia. So, those markets really went their own ways. So, it got crazy for soybeans, but correlations did not rise. In fact, they stayed pretty low across some of the agricultural products. So, and we can see the same thing in metals. Gold is a very precious metal that people hold for, as a defensive measure in their portfolios. It's an asset class almost on its own. Central banks own it. And then you've got the industrial metals, copper and lots of other things, and they dance to a totally different drummer whether there's a crisis or not. So, if we did have an economic crisis where we went into a recession, the Fed would lower interest rates and gold might very well rise. And copper, would go the other way. So the listener's quite right. This works for stocks, but it doesn't work so well for the commodities.
Yeah, it's a sexy thing to say, you're right, when it's all hitting the fan in the equity market, and that certainly applies across the indices there. When you start getting beyond that, it gets a little bit more tenuous, but it is a fun thing to say at the end of the day. So I could see why you'd be intrigued there, listener. Uncertain. You are. That's actually an appropriate handle for your question. All right, let's see. I think we got time for, we can do one more here, Mr. Blue. This one came in, I think, a little while ago. When they came across the show notes, I said, nope, we have to save this one for Blue. I knew you were coming on in a week or two. This comes from Andrew Testa. He says, I love the TWIFO. Well, thank you. And he goes on to say, and I wouldn't mind more ag reports, trying to learn that marketplace for myself. I'm still in the phase of trying to figure out the difference between El Nino and La Nina and which is the good one for ags. Thanks for all your great shows. Enjoying the new crypto rundown. Well, Andrew, thanks for that. We're putting a lot of effort into that show. It's kind of fun to break down a new marketplace, have a new audience, new contributors, all sorts of fun new stuff going on with that crypto rundown. Listeners, if you hadn't heard it for yourself, that records live. A little bit different time, a little bit later, because we have so many international contributors to that at 4 p.m. Central, 5 p.m. Eastern on Monday. Of course, you can get it after the fact, wherever you get our fine podcast program. So hopefully you've already been checking it out and indeed enjoying it. Thanks for that, love. But Blue, when I saw El Nino and La Nina, I knew this is right up your alley. I've said it before. I've never met an economist who loves El Nino more than you, sir. So have at it, sir. Educate our friend Andrew on the difference between the two and which one is good and which one maybe could be bad or vice versa for the ag complex, sir.
Yeah, it sounds good. No, I do love looking at the weather. You know, I started sailing when I was a kid, and long before I became an economist. And sailors just love to talk about the weather. So I'm going back to my roots here. Here's what's going on. So El Nino is warm water on the Pacific Ocean near the equator. And warm water, it evaporates more than cold water. And that evaporation gets into the air, and depending on which way the wind blows, it comes down as rain. La Nina is the little girl, El Nino is the little boy. Anyway, La Nina is cooler than normal water along the equator in the Pacific Ocean. And, of course, cooler water doesn't evaporate quite as much, so it's not as much rain, again, depending on where the winds blow. And so you can get some drought conditions depending. So, in general, El Nino is good for crop production, particularly in Brazil and Argentina, but also it affects the United States positively for you're going to get more corn, more soybeans per acre. It's going to be a good crop. Now, whether that's good for you as an ag trader or not depends on which side of the market you're on, whether you're a hedger or a speculator, so forth. So I won't say whether it's good or not for ags. La Nina is the one that can disrupt growing patterns depending on if a drought occurs or not. And so with the La Nina, you do tend to get more ag price volatility because of it disrupts production around the world. One thing about El Nino, in South America, North America is generally positive for crops. It tends to be negative in Australia. So if you're looking at Australian wheat or something like that, an El Nino, actually the warm water in the Pacific is partly offset by cooler water in the southern Pacific around Australia, and so they can have a little worse drought conditions. Other thing to mention about these El Ninos and La Ninas, every one is different. There are patterns that I've just been talking about, the general patterns, but the context matters. And like the last El Nino, the big one we had in 2015, things like that, we had a lot of really warm water in the Pacific Ocean off Canada and the northwest U.S., so that even added to the precipitation. So you've got to look at some other things that are going on in the oceans around the world besides El Nino and La Nina to see how things might differ from one to the other. We're in El Nino now, but it's not as strong as the last one, but it is fairly favorable for production of crops in South America and North America.
How did I know, Blue, that one would resonate with you? I saw that, so we have to save that for Blue. The man loves himself a good El Nino. Unfortunately, listeners, that music means we've come to the end of our TWIFO program for this week. We hit a lot of complexes. There's always more we could do. We didn't get a chance for FX or a few of the others, but there's always more. That's the fun part of the show, is that what can we squeeze into our nice tight 45 or so minutes here on the show. But before we go, Blue, if you have any other complexes we didn't hit on, maybe you want to touch on them really quickly, or perhaps you want to leave our audience with a little bit of a hint, a little bit of a tease of what research is coming down the pike from you and Eric and the rest of the research team at CME. Now is the time, sir. The floor is yours.
Well, we have some two lines of interesting research, I think. We're going to do a very deep dive into China over the next week or so. There's just a lot going on there. You've got to think about the long run. They're an aging population. They're not having kids as much, even though they got rid of the one-child policy. That it's not making much of a difference. and their migration of people from the farm to the city is starting to slow down. So their long-term growth rate is going to be a lot slower than what it is today. And then in the short run, you've got the trade war going on. So we're going to take a deep dive into China over the next week or so. The other thing we've got going, which is really kind of interesting to me, is we're doing a whole lot of research into the risk management sector. And what we're doing there is, if you look at options and you look at the implied volatility, you can really underestimate the risk. Volatility is a good measure of whether it's getting riskier or less risky, but it doesn't really capture what happens during event risk periods where it could go one way or the other way. Like take Brexit. If they don't get a deal, you don't want to own the pound, and if they do get some deal, you do want to own the pound. And you have the same thing with the U.S. shutdown and with the trade war on March 1st. So those kind of things we call event risk, and they produce a lot more risk than you actually see in the implied volatility. So we're going to be coming out in February, probably late February, with our research on risk management. So I think that'll be very interesting to options traders.
There you go. Check out what Blue and his team are working on. The easiest place to go, cmegroup.com. A lot of it's right up there on the homepage. You can't miss it. So check out his latest, including his market challenges in 2019 video, where he breaks down a lot of what we talked about here and a little bit more on that video, and all the other good stuff he mentioned, including the event risk coming soon. And of course, while you're out there, make sure you head on over to quickstrike.net. Sign up for the big boy version of Quick Strike. We can see all these reports we talk about here on the show and quite a bit more. All the changes to skew, the historical graphs, all the data, all the good stuff that if you're trading these markets, you really do need. Quickstrike.net or Bantix, BANTIX.com, the place to go to learn more. And of course, last but not least, our friends over there at FTSE Russell, they're traveling again this week, couldn't join us. Head on over to FTSE, FTSE Russell.com for all the data they have about the buy rights and the over rights and the put rights and all the things about active versus passive. Give them a follow on Twitter while you're at it as well, at FTSE Russell, FTSERussell.com. You get all that data throughout the week as well. And on behalf of myself and Blue and our friends at Quick Strike and our friends at FTSE Russell, and indeed myself, I want to thank all of you out there for downloading, streaming, subscribing, sending in questions, listening live, all the fun stuff that you guys do. Keep it all coming, and we'll see you back here next week for more of This Week in Futures Options.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.